Harvest Minerals is a London-listed producer of organic fertiliser products with its flagship operation, the Arapua project, is in Brazil. It's recently reported a widening interim loss on higher than anticipated costs, but its revenues are rising. Dr. Mark Heyhoe is Chief Operating Officer. He joins us now with some more. Welcome back. When we last spoke to you, you just raised over £9 million sterling. You've seen these most recent numbers come out, and I know that some are focusing on cost, but you've got a revenue rising. Your chairman, Brian McMaster, says there's a lot of moving parts here. Explain what's going on.
Yeah, I mean, last time we came and saw you, we just raised a £9.4 million. And that was essentially for working capital. We need a working capital injection. We also needed some capex to put in the plant expansion to take us from the trial processing plant up to the 320,000 tonne capacity and really sort of build up the sales team. Because over the last 2 years, obviously we developed a project, we developed a product, and it's a question about the sales and marketing and how we develop and grow our revenue. In terms of those figures we just saw now, we saw a strong growth in our revenue. It rose from $47,000 for the same period the previous year up to just over $1 million this time, and that's a reflection of the contracts we put in place at the early part of the year. Now, those contracts were two sort of major distributors. We delivered into those. The advantage of selling into those distributors were, when we had little or zero cash, we had little or zero sales team. We had one sales guy, and by using a distributor like that, Agri Serrada, for example, had 100 salespeople. They had 10 sales offices. It gives us a fast track to build up a sales team and get out into the market. And all our contracts today, all our sales today, are largely being into those two contracts. Now, the flip side of that is obviously those guys are selling into multiple products into their sales channels, and if a customer has already got a preference for one particular product, it's a harder job to get them to shift into a new product like we've got in KP Fertile than it is to sell him what he's already taken. So we spent the most part of last financial year and the first quarter of this time really focusing on those contracts, getting our sales guys, our technical staff to support them in sort of developing their sales, and we showed very good, strong growth into that. However, those contracts were quite large, and we expected to get a bit more traction in there. It didn't quite happen as quickly or as fast as we would have liked, but we're still pushing into those. So in the meantime, we've been expanding our own sales team. We've now did a JV with a group called Geociclo to try and get in on their sales team. That didn't quite work out, but as a result of that, we took their sales team. We've streamlined out and added a couple of extra people. So now we've got our own internal sales team of 6 sales staff and a sales manager. Plus, we've put in a marketing team to help us sort of build a brand, get out and talk to customers. So all our sales teams now are out there talking to customers, talking to consultants and other groups who have an interest in taking on board our product. And that's going to be where, primarily from our sales going forward, is going to come from.
Yeah, just want to focus in on the costs very briefly, if we can. The exceptionals that you took in the interims. What more costs are coming through? I mean, presumably we know about all the costs that's still in the pipeline.
Yeah, I mean, probably those exceptionals were largely the share-based payments, which were obviously documented in the RNSs. 3/4 of those have gone out, with still a quarter to come through on a full mining permit. There's a little bit of delay in switching on to grid power, which we've now got, and largely that's what all the exceptions were. There may be some coming up in terms of still got 25% outstanding, maybe this half, maybe next half. And when we do get the final mining permit, we are also due to give up to a $1 million payment to the original vendor. Now, that may be, again, this half or early second half, depending on when that permit's coming in and when the payment's made. We also had people I want to highlight here about the consultancy fees, which were mentioned in the cost there, which seems higher to some people than they would expect. Part of the reason for that is that we are an Australian company, listed in the UK, but operating in Brazil. So some of the costs, which would normally be staffing costs, are actually classed as consultancy fees. So it's myself, and obviously David came on as a CFO during the period, so that will increase our consultancy fees, and also for the accounting, as we shifted from exploration into development, some of the costs got reclassified from capex into opex. And then furthermore, a large chunk of that was also deferred costs from the previous period, because as we said, we were running out of working capital in the second half of the financial last year. We did the capital raise, which allowed us then to back pay some of the consultancy fees which were due, which is why it appears slightly higher than expected. And that's the same for the exceptionals. We had some accrued costs in there as well.
In the longer term, I mean, you still have yet to achieve full commercial production. That's got to be said as well, hasn't it? So you're putting everything in place at the moment, are waiting for that moment. When is that likely to happen, and at what cost?
Yeah, I mean, we put in place all the operational moving parts are in place now. We put the plant expansion there, takes it to 320,000 tonnes of capacity, and it's really about driving up there. Now, break even for us is around 50,000 tonnes of sales, which we're pretty close to as it is now. It'll either should be this half, if not early second half when we get to that sort of level, depending on payments and things. So at the moment, we're operating costs around about $15 per tonne on site. This half we'll get them down far lower than that, touching about 10 for a combination of reasons, largely because reduction in fixed costs compared to the production, and also the grid power will keep our costs more stable. And as we get up to 100,000 tonnes, the cost will continue to fall around about $7.50 per tonne.
In terms of sales price, how does that work out in revenues?
Yeah, well, basically we have a flat sales price, no matter who the end customer is. It's 200 real per tonne, which is roughly about $53 per tonne at the moment. It varies, the exchange rate was about 60. In the revenue numbers, you'll see most of our sales were through a distributor. So the revenue we get from them is less their sales fees and their commissions, the payments we pay to them. So it's slightly less than what you would from equivalent sales directly from our own sales team, which obviously we get the full 200 real per tonne from them.
When I started the interview, I was talking about the 9.4 million sterling you raised when we last spoke. What is your cash position now and the cash burn rate? Because that's clearly something investors want to know about.
Yeah, I mean, we ended the financial year 2012 in those results with just short of 12 million Australian dollars, which is about 6.4 million pounds sterling. I mean, if we continue doing what we're doing and had zero revenue, we could keep going for the next 3 years without having to raise any more working capital. So we're in an exceptionally strong position. We don't need to come back to the market to raise any money as it is now. And really our focus now, as well as delivering into those contracts with the distributors we've got, has been on ramping up our own sales team, ramping up our own sales efforts, and particularly on the marketing side, doing more test work, getting involved in more field days, more consultancy groups, and really building up an appetite and an awareness of our product. And that will start feed through now. I said we ramped up with Geocycler at the end of last year in terms of building the sales team. We rationalised some of those guys, got some more people in. We've got 6 sales guys at the moment. I've got 2 gaps I need to fill geographically, so I'll bring in another 2 because it's 8. Plus our sales manager came on board early February again, who knows our product, and that'll start feeding through. And that's really sort of growth in terms of the sales period is from April through to November. First part is really coffee and fruit trees, and then from sort of July period onwards, sugarcane and soybean comes in as well. So that's really our peak period, and we're sort of getting into that period now. Yeah,
let me just bring up a copy of the share price if we can to take a look at where we are. This is share price showing the recent drop we've had in the wake of the numbers that you had out recently. This goes back to July 2016. What are investors buying into at this level? I mean, what does this represent in terms of the business?
Well, I mean, you probably have every CEO comes in here and says that their share price is undervalued, but you look at what we've achieved over the last 3 years, and what the share price is telling you is that the share price currently, we had more value as a greenfield and an exploration project than we do having developed a mine, got into production, developed a new fertiliser product, putting a sales team and generating revenue, plus having 6.4 million in cash in the bank. There's clearly a mismatch there in terms of the valuation. That's really what people are buying into. The fact we no longer need to raise any working capital. We've got enough for the next 3 years if we didn't need revenue. We've got a growing revenue stream and our costs are coming down. Yeah, and we're on the brink of being break even in terms of sales volumes.
You gave a little bit of an insight into how the year's going to develop in terms of some of the crops and so forth. What do you see as the major milestones to watch out for? Brian McMaster, the chairman, said, forgive us if we don't pump out news all the time because we're building the business. But what is going on under the covers that investors don't know about that perhaps maybe might give them a more positive outlook?
Yeah, I think from what we can talk about, I mean, the big milestones operationally is really just getting a full mining permit, which should be due this half, early next half. And then above and beyond that, it's really about the sales and marketing team. So we've got 2 places to fill in terms of the sales team. We're doing a lot of work in agronomic work. These guys are going out and meeting clients, doing field days, working with the cooperatives, looking at new ways to deploy and develop our products. So looking at, can you combine it? We can with compost to produce a new type of, fully multi-nutrient fertiliser, doing it with coffee husks and things like that, and how you can apply it during the life cycle of, say, sugarcane. And these are opening up new markets. It's a completely organic product as well. There's a range of benefits. So not just in terms of cost, not just in terms of the benefit of using our product. There's a whole range of other benefits which people will see over the medium term from using our product, and it's just a question of getting them to buy in. They're coming back, buying some of the products. Everybody who we sold to previously has come back and bought more, is in the process of negotiating for more product. So from that point of view, it's been readily accepted. It's just, you know, it just takes longer than as a new product to get market growth.
Yeah.
Yeah.
Okay. Well, look, we'll look forward to the news as and when it does come through, whatever that news is. But Mark, in the meantime, thanks indeed there for joining us. That was Mark Heyhoe, the Chief Operating Officer of Harvest Minerals.